Alex checks his banking app every Sunday night. He has $18,000 sitting in a high-yield savings account paying 4%. On paper, that account earned $720 this year. Alex feels good about that number. He should not. Because tax season arrives, and the IRS treats every single dollar of that interest exactly the same way it treats his paycheck, not as a reward for saving, as ordinary income. After federal tax, after state tax, the $720 Alex thought he earned shrinks to roughly $520, $200 gone before he ever touched it. And here's the part that should actually concern you. Once you factor in the real cost of living rising every year, that account barely kept pace. In some years, it lost. Alex did everything the YouTube finance gurus told him to do. He still came out flat. Welcome to Fin Finance Subscribe and tap the bell right now, because in a few minutes, you are going to learn exactly why your high-yield savings account is quietly taxed harder than almost anything else you own, and the 3 places your extra cash should actually live instead. Let us get into it. Here is what almost nobody explains when they recommend a high-yield savings account. The advertised rate is not the rate you keep. It never was. The most recent heirs tax brackets tax interest income exactly the same as wages at your full ordinary income rate. For someone in the 22% federal bracket, that means 22 cents of every single dollar of interest disappears before it ever reaches a real bank balance. Add a state income tax, and many states take another 5 to 9% on top of that. Stack those together, and the average saver is losing roughly 30% of every dollar their HYSA earns. 30%. Now compare that to the most recent inflation data, hovering around 3% a year. A HYSA advertising 4% after taxes often nets a saver somewhere between 2.8 and 3% in their pocket. Read that again. The high-yield account after tax barely beats inflation. Sometimes it does not beat it at all. This is not a flaw in any single bank. It is built into how the entire system treats this type of account. And almost nobody selling you on a 4% rate will ever mention it. Think about selling something on a resale app, sneakers, a phone, an old game console. The listing says you will get $100. You feel good about that number. But by the time the app takes its selling fee, the payment processor takes its cut, and a final transfer fee gets deducted, the amount that actually lands in your account is closer to $85. You never agreed to lose $15. It was just quietly built into the system before you ever clicked list item. That is exactly what happens to the interest in your high-yield savings account. The advertised number is the listing price. The number you actually keep is what survives after every silent fee, and the biggest fee of all is not charged by your bank. It is charged by the government every single year, automatically, with no exceptions. Here is why this trap catches so many people. Every popular finance video tells you to open a HYSA as the smart first move. And that advice is not wrong. For your emergency fund, a HYSA is still one of the safest tools you can use. But the advice usually stops there. Nobody explains what happens once your emergency fund is full and you keep parking extra cash in that same account year after year, getting taxed on every dollar of growth like it was a paycheck. The account that was supposed to protect your money quietly becomes one of the least efficient places to grow it. Here is the part that nobody talks about, and it is the most important part of this video. You did not make a mistake by opening a HYSA. The mistake almost everyone makes is assuming a financial decision that was right once stays right forever. Psychologists call this the status quo bias, that is the tendency to keep doing what already feels safe, even after the situation has quietly changed. When you opened that account, it solved a real problem. It gave you a safe, liquid place for your emergency fund. Your brain logged that decision as solved and moved on. But your situation kept evolving. Your balance grew, your tax bracket may have shifted, inflation kept climbing in the background. And the account that once felt like the smart move never got revisited. This is not laziness. This is how the brain protects its energy by trusting decisions it already made instead of constantly reevaluating everything. There is a second force working alongside it, and it is just as powerful. Psychologists call it the endowment effect, the tendency to value something more highly simply because you already own it. Once that HYSA became your account, it stopped being evaluated on its own merits. It became part of your identity as a responsible saver. Questioning it started to feel like questioning yourself. This is exactly why so many people defend a 4% account with the same energy they would defend a decision they are proud of, even when the math quietly stopped working in their favor. Add one more layer. Every bank statement you receive shows your balance going up. Up feels like winning. Nobody sends you a second statement showing what the ears quietly took, or what inflation silently ate. You only ever see the number that makes you feel good. The losses are invisible by design, not hidden on purpose, just never shown on the same screen as the gain. That is why this mistake survives so easily. It never feels like a mistake while it is happening. The problem is, money does not stay still just because your attention moved somewhere else. Every year that extra cash sits in that account untouched, it is quietly losing a fight against taxes and inflation that you never agreed to fight. Think about how this plays out for someone real. Maria opened her HYSA 3 years ago with $2,000. Today, that same account holds $26,000. She never closed it. She never questioned it. She just kept adding to the thing that already felt safe. In her mind, the account has only ever done one thing grow. She has never once seen the version of her statement that shows the $800 she lost to taxes last year, or the $400 she lost to inflation the year before that. Nobody shows her that statement. So in her mind, the decision she made 3 years ago is still working perfectly today. That is the trap. Not bad math. Invisible math. The fix is not complicated. It just requires looking at a decision you assumed was already finished. Let's make this concrete. Take someone with $30,000 sitting in a HYSA earning 4%. That is $1,200 of interest in 1 year. Before tax, that feels like real progress. After a combined 28% in federal and state tax, that interest drops to roughly $864. $336 gone to taxes alone. Now subtract inflation at 3%. The real, after-tax, after-inflation gain on that $30,000 is closer to $150 for the entire year. $150 on $30,000 of savings. Remember Alex from the start of this video. His $18,000 is smaller than this example, but the pattern is identical. Run his numbers forward 10 years without ever revisiting the account, and the gap between what he could have kept and what he actually keeps grows past $3,000 money that simply evaporated into tax brackets and inflation, while his balance kept climbing on screen. Compare that to the same $30,000 sitting in a Roth IRA, a retirement account, where qualifying growth is never taxed again, not this year, not in 40 years. The exact same investment, growing at the exact same rate, keeps every single dollar of growth. Same risk, same starting amount. One account quietly bleeds value to the IRS every single year. The other lets the entire gain compound, completely untouched, for decades. This is not about HYSAs being bad. This is about where your money sits after your safety net is already built. Here is the rule. Keep your true emergency fund 3 to 6 months of expenses exactly where it is, in your HYSA. That part of the advice was always right. But for any extra cash beyond that emergency fund, here are 3 places that quietly beat the tax drag. Option 1, a Roth IRA. A Roth IRA is a retirement account where you contribute money you have already paid tax on and in exchange. Every dollar it earns afterward grows completely tax-free forever. You can withdraw your original contributions at any time without penalty, which makes it more flexible than most people realize. For 2026, most people under 50 can contribute up to $7,000 a year. This is usually the very first stop for extra cash once your emergency fund is full. Option 2, Treasury bills and I-bonds. These are short-term loans you make directly to the U.S. government, and they pay you interest in return. The advantage: the interest is exempt from state and local taxes, only federal tax applies. If you live in a state with high income tax, this alone can meaningfully close the gap a HYSA can't. Option 3, municipal bonds. These are loans made to state and local governments, often used to fund roads, schools, and infrastructure. The interest is usually exempt from federal tax entirely, and if you buy bonds from your own state, often exempt from state tax too. This option tends to fit best for people already in a higher tax bracket, where the tax savings matter most. This is exactly the move Maria needs to make with her $26,000. $6,000 of it covers her real emergency fund and stays exactly where it is. The remaining $20,000 has been quietly losing the same invisible fight every single year, and moving it into a Roth IRA is the 4-minute decision that finally stops the bleeding for good. Here is exactly what to do this week. Open your banking app. Look at your actual emergency fund balance versus your total HYSA balance. Anything sitting above your true 3 to 6 month cushion that is the part quietly losing the tax fight every year. Move that portion, even gradually, into one of the 3 options above. Your true safety net stays exactly where it is. Everything beyond it finally stops bleeding to a tax bill you never noticed. Most people think a smart financial decision, once made, stays smart forever. It does not. Money has to be rechecked the same way you'd recheck a recipe you've made 100 times, because the ingredients around it keep changing. You just found one decision worth rechecking tonight. Hit subscribe and tap the bell. Every video on this channel hands you back a few dollars the system was quietly taking without asking. There's another video waiting for you right now. What you click next is the next decision your money is about to make.